The year is 2021, and the global financial system is operating in a state of tranquil yet profound delusion. For over a decade, since the ashes of the 2008 global financial crisis settled, central banks across the world, led by the U.S. Federal Reserve, had engineered an unprecedented era of free money. Interest rates were anchored near zero, and central banks engaged in massive quantitative easing, QE, buying trillions of dollars in government bonds to flood the system with liquidity. This was the engineered cure for the 2008 crisis, but it created an entirely new, gargantuan risk that few saw coming: the Great Bond Bubble. Bonds, traditionally considered the safest, most boring assets in finance, suddenly became speculative vehicles. In a world starved for yield, any guaranteed return, no matter how minuscule, was fiercely bid up. As interest rates approached zero, the price of existing bonds soared to historic highs. Trillions of dollars of capital, from pension funds and sovereign wealth funds to simple retail savings, were poured into these assets. The prevailing belief, fueled by decades of low inflation, was that central banks would never risk the delicate stability they had painstakingly created, meaning rates would remain low forever. This consensus became the fatal assumption. The financial world had implicitly priced in permanent low interest rates. This scenario created a ticking time bomb disguised as stability. When an investor buys a bond, they lock in a fixed interest payment, or coupon. When interest rates rise, newly issued bonds offer higher coupons, making the existing bonds with low coupons, like those issued during the 2010s, instantaneously less attractive. To sell these old bonds, the investor must drop the price significantly. The risk is inverse and exponential. Bond prices fall when interest rates rise. And because the rates were so near zero for so long, the market was primed for a historic fall. The longer the duration of the bond, the more brutal the price fall when rates finally moved. The central bank's blunder was twofold. First, they normalized an emergency measure, QE and zero rates, for over a decade, training the entire financial ecosystem to rely on artificial cheap credit. Second, when inflation, the one force that guarantees higher interest rates, finally roared back in 2021 and 2022, central banks were dangerously slow to acknowledge it, repeatedly dismissing it as transitory. This denial was the crucial failure of foresight. By waiting too long to act, they allowed the inflationary fire to burn out of control, necessitating a dramatic, painful, and rapid rate hike cycle that would crush the bond market. When the Fed and other banks finally admitted the necessity of fighting inflation, they were forced into the fastest and most aggressive rate hiking cycle in 4 decades. This immediate, sharp reversal broke the financial world's most fundamental assumption. The vast ocean of bonds purchased at high prices when rates were 0.5% suddenly lost billions, then trillions of dollars in value as rates rocketed past 4% and 5%. This massive destruction of bond value became the most expensive, silent financial disaster of the decade, hitting the quietest, most risk-averse corners of the financial system: the pension funds, insurance companies, and banks that were legally required to hold safe bonds. The hidden bubble had burst, and the damage was about to cascade into every sector of the global economy. The destruction of value in the bond market, a silent mathematical catastrophe, quickly began to expose massive systemic failures in risk management among institutions that were supposedly the most conservative. This was the moment the hidden leverage and the reliance on cheap debt, baked into the system during the free money era, came back to haunt the global economy. The first major structural failure occurred in the highly complex, opaque world of UK pension funds, an event that brought the British financial system to the brink of collapse in September 2022. The specific blunder was the widespread use of liability-driven investment, LDI, strategies. In theory, LDI is designed to ensure pension funds have enough assets to meet future obligations to retirees. To do this efficiently, many funds invested in long-dated bonds, which provided stable returns. However, to boost those returns in the low-rate environment, These funds engaged in heavy leverage, borrowing money to amplify their bond holdings. When interest rates suddenly surged in the wake of the government's controversial mini-budget, the value of those long-dated bonds plummeted. This triggered a wave of margin calls on the borrowed money. Pension funds, forced to sell assets immediately to meet these margin calls, created a death spiral in the market. The forced selling of bonds pushed prices even lower, triggering more margin calls and plunging the funds deeper into insolvency. The crisis was so rapid and severe that the Bank of England, BOE, was forced into an unprecedented emergency intervention. The BOE had to step in and become a buyer of last resort for long-term UK government bonds, effectively injecting tens of billions of pounds of liquidity to stabilize the market. This intervention exposed a fundamental risk management blunder. Institutions responsible for the retirements of millions of workers had inadvertently placed massive destabilizing leverage on the assumed stability of the bond market. Simultaneously, across the Atlantic, the same bond market collapse triggered a catastrophic failure among mid-sized U.S. regional banks, culminating in the dramatic collapse of Silicon Valley Bank, SVB, in March 2023. SVB's blunder was less about esoteric leverage and more about gross mismanagement of interest rate risk. During the easy money boom, SVB accumulated huge cash deposits from the tech sector. Instead of lending this money out aggressively, they did the safe thing. They invested billions in long-dated, low-yield U.S. Treasury bonds and mortgage-backed securities, believing these assets were risk-free. The problem was that these bonds were safe only if held to maturity, but their market value was extremely sensitive to rising rates. When the Fed hiked rates, the market value of SVB's bond portfolio, the available for sale and held to maturity portions, suffered catastrophic paper losses that eventually exceeded the bank's entire equity. When SVB's depositors, primarily VCs and tech companies, began demanding their money back due to a sudden cash need, the bank was forced to sell these bonds at a massive loss to meet the withdrawals. This confirmed the bank's insolvency, triggering a panic and a bank run that spread across the regional banking sector. The failure of SVB and other regional banks demonstrated a chilling oversight. The assumption that government bonds are risk-free assets is only true if they are held to maturity and if the owner can withstand the short-term market fluctuation. For banks dependent on immediate liquidity, holding massive quantities of low-yield, long-duration bonds was an act of financial negligence, not conservatism. The Federal Reserve, by pushing rates so rapidly, exposed a massive failure of banking supervision. The bond market collapse had successfully managed to break institutions on both sides of the Atlantic, pension funds and banks, that believed they were entirely safe, revealing that the trillions poured into cheap debt had been silently building a highly leveraged house of cards. The price destruction was no longer silent, it was causing systemic institutions to fail. As central banks scrambled to hike rates and bond values plummeted, a classic, almost infallible warning signal began blaring in the market. The inverted yield curve. This is not just a technical term, it is historically the most accurate predictor of an imminent recession in the United States. The yield curve normally slopes upward, meaning investors expect a higher return yield for lending money to the government for a long period, e.g. 10 years, than for a short period, just about 2 years. This is normal economics. More long-term risk demands more reward. Inversion occurs when the short-term interest rate surpasses the long-term rate, an anomaly that indicates investors are more concerned about short-term instability and, crucially, expect the central bank will be forced to drastically cut rates in the future to rescue a collapsing economy. This expectation of future cuts is what depresses the long-term bond yield. The blunder here was not the inversion itself, but the way many analysts, and even the Federal Reserve itself, initially tried to dismiss its significance, arguing that this time is different due to the distortions caused by QE. However, history did not lie. The inverted yield curve, which deepened dramatically after the rate hikes of 2022, signaled that the cost of fighting inflation would be a collapse in credit and economic stagnation. The real cost of the bond market collapse translated into an immediate and severe increase in the cost of credit for the real economy. The world's most important interest rate, the rate on U.S. Treasuries, functions as the baseline risk-free asset. When the yield on these bonds rises, the cost of borrowing for everything else in the economy rises along with it, following suit. The impact was felt with particular violence in sectors addicted to cheap money. The housing market was the first to freeze. The U.S. mortgage rate, which hovered around 3% during the QE era, skyrocketed to over 7% in many regions. This made housing unaffordable for millions of buyers, crushing construction and sales activity. Home values stalled or fell in many areas, creating an affordability crisis for new buyers and stress for homeowners who depended on cheap refinancing. Equally critical was the impact on the vast ecosystem of venture capital and technology companies. These companies, many operating at zero or negative margins, fundamentally depended on cheap debt financing and venture capital. With interest rates high, VCs demanded returns rather than just growth at any cost. Thousands of startups that thrived in the easy money era were suddenly forced to slash costs, resulting in tens of thousands of layoffs across the technology sector. This was the end of the burn cash growth model and the beginning of a painful financial reckoning. Furthermore, the bond collapse exposed the vulnerabilities of corporate debt. Many companies had issued low-cost bonds maturing in the coming years. These companies now face the so-called refinancing wall. When their current bonds mature, they are forced to issue new bonds at significantly higher interest rates on e.g. 10%, paying 7% instead of 3%. This increase in the cost of debt service eats into profits, reduces investment, and increases the risk of bankruptcy, especially for the most leveraged firms. The central bank's macroeconomic blunder in delaying action against inflation necessitated an interest rate shock that did more than just control prices. It permanently recalibrated the cost of global capital. By destroying trillions in bond values, the Fed and its peers slammed the brakes on credit expansion. The net result is a global economy that is now forced to operate with expensive capital, a transition that is causing widespread pain and proving that the era of free money was not a gift, but a massive debt transferred to the future through inflation and the cost of credit. The inverted yield curve and the subsequent credit crunch prove that the cost of failed monetary policy is paid by the real economy. The trillions lost in the bond market are absorbed by companies laying off workers, by families unable to afford homes, and by nations struggling to finance their debts. The silent destruction of value from Act 1 translated into the tangible, noisy pain of Act 3. The problem, however, did not stop at credit. The geopolitical consequences and the future of currency were still to come. The collapse of the global bond market, the silent destruction of trillions in asset value, had repercussions that extended far beyond bankrupt regional banks and struggling pension funds. The rapid, aggressive rate hikes necessitated by the failure to contain inflation earlier triggered profound geopolitical shifts, altering the fundamental architecture of global finance that had been stable since the Bretton Woods Agreement. The primary victim of this instability was the unchallenged dominance of the U.S. dollar and the U.S. Treasury bond market as the world's ultimate safe haven. For decades, central banks and sovereign wealth funds across the globe held trillions in U.S. Treasury bonds, viewing them as the single safest, most liquid asset available, the foundation of international trade and reserve currency status. The events of 2022 and 2023 shattered this assumption. First, the rapid decline in bond prices inflicted significant paper losses on these foreign holders, illustrating that U.S. Treasuries were not immune to dramatic market volatility. Second, the increasing use of financial sanctions by the U.S. government against geopolitical rivals, such as the freezing of Russian central bank assets, highlighted the political risk inherent in holding U.S. dollar-denominated assets. This combination of financial volatility and political weaponization of the dollar sparked the phenomenon known as de-dollarization. Nations, particularly major emerging economies and strategic rivals like China, began actively seeking alternatives to the dollar for trade settlement and reducing the share of U.S. Treasury bonds in their reserve portfolios. While the dollar's dominance is too entrenched to fall overnight, The bond market collapse provided the decisive incentive for nations to accelerate their search for non-Western trade corridors and alternative reserve assets, such as gold or other currencies. The final cost of the bond blunder, therefore, includes the erosion of America's primary tool of global financial influence. Domestically, the ultimate legacy of the free money era is the forced recalibration of central bank policy. Policymakers and economists broadly conceded that the decade of near-zero rates was an anomaly that should not be repeated. The consensus shifted towards accepting a higher neutral interest rate, a rate that neither stimulates nor constricts the economy. This acceptance means that the cost of capital in the future will likely be permanently higher than the average experienced between 2009 and 2021. For the economy, this is a profound change. Higher borrowing costs for consumers, higher hurdles for corporate investment, and reduced asset price inflation. The reversal of a decade of financial euphoria. The financial crisis of the mid-2000s was not triggered by a housing bubble or complex derivatives, but by the failure of simplicity, the failure of central banks to manage inflation, and the failure of regulated institutions to manage basic interest rate risk on government bonds. The trillions lost in the bond market were the collective debt paid for the decade of inaction and denial. The final, enduring blunder of the free money era is that it made the financial system fundamentally less resilient, ensuring that when the inevitable inflationary pressure arrived, the cure had to be administered so violently that it broke the very institutions designed to be the pillars of stability. The bond market collapse was not the problem. It was the trillion-dollar symptom of a profound, decade-long policy mistake. Please subscribe if you're enjoying our content.